Hello and welcome to With Well and Anderson. This is going to be every 3 weeks. I'm going to give you a survey on what's happening in the current economic climate today and what you need to do in order. Well, let me step back for a moment. When I do these surveys, they're going to be in very simple, plain English. I'm going to use economic terms, but I'm going to explain to you what they are in English. So when you hear them, you're going to be able to discern what they are yourselves. So they'll be every 3 weeks. I would suggest it if you're on YouTube, subscribe so you don't miss anything. If you're on Facebook, give it a follow, and you should be good. Okay, what we're going to talk about is basically the recession or the potential of a coming recession. What is a recession? Okay, a recession is 2 consecutive quarters of negative GDP or gross domestic product decrease. Okay, so what is gross domestic product? Gross domestic product is the annual amount of finished goods that are developed by a country with its imports extracting the exports. Okay, that's the measurement. Now it has to be a finished good. What I mean is a house built 10 years ago that you sell this year is not considered part of the gross domestic product. But a new house built this year, sold this year, is part of the gross domestic product. Okay. The other signs of recession are obviously when wages and credit begins to tighten. Okay. Unemployment rises. You have little or slow housing starts. Prices begin to drop. You get more renters than buyers. The cost of credit increases. Part-time workers are hired more than full-time workers. The markets drop. Bond rates rise. And eventually, you can go into deflation. Now, we're doing this summary. Today is 7/10/22. Okay? And we are not in recession technically right now. Okay? Now, what does this mean to you? These are some of the tools which the economists use also besides the gross domestic product. But in order for you to understand this, you're going to have to understand what a central bank does. In the United States, the central bank is called the Federal Reserve Bank. Okay? And its role in the economy is varied. They mainly stabilize the economy, and they also control the money supply and the tool and the money supply and the rules of the economy. The Federal Reserve and all central banks, at least in the United States, we call it something called the federal funds rate. The federal funds rate is the rate that banks lend each other overnight. Let me give you a little story about how this might click. If you're my age or maybe even younger, you may have seen It's a Wonderful Life with Jimmy Stewart. And he plays George Bailey. And all of a sudden, a rumor gets out there they don't have money. And people come and line up at the bank looking for their money. The federal funds rate is a reserve amount of money that banks lend each other overnight. And the reason why they do that is because they need to have a certain amount of reserve that falls under the guidelines of the Federal Reserve in order to open for business. This is the best possible rate you can get. When the federal banks lending to banks is the best rate. Once that rate goes up, it's usually a bad sign. So now we know what the reserve is. The reserve is the amount of money that the bank has to have in order to open in the morning, okay? And that's used to tender what the bank services. Okay. Now we're going to talk a little bit more about the central banks. They are the lender of last resort. As I said, they control the money supply. In the United States, a central bank is not part of the government. It's a separate organization. And they set the interest rates when they meet every 6 weeks in a special committee. And the interest rates, again, is another tool that the Fed uses in order to keep the money supply in order. Another indicator that the economists use is they use looking at the markets. The market I'm going to pick is going to be the Standard & Poor's 500. And the reason why I'm picking that is the largest varied market. It has 500 blue chip companies, American companies, and it's one of the best gauges you can use. I'm going to give you some background on what's happening with the S&P. On May 27th, it closed at 4,100 and change. On June 17th, it dropped 6%. But on July 8th, it was up 1%. So we don't really see a pattern here. There isn't any that's not telling us much yet, except that we know that between the 3 months, it's dropped 5%. That's not a good sign. Now we're going to talk about a tool that is absolutely critical. It's called the ISM PMI. Don't start flipping the channel. Okay, I'm going to explain to you what they are. The ISM is the Institute of Supply Managers, and the PMI is Purchasing Managers Index. Why is that important? It's measured with a 6-month forward looking. Why is that important? Okay. The ISM uses the PMI to judge what are purchasing managers looking to do in the coming 6 months. Are they going to hire more people? Are they going to get more inventory? Do they expect more sales? Do they expect logistics problems? Or supply chain problems? All this data that goes to the economist gives them a flavor for what the economy is going to look 6 months down the line, because these are purchasing managers. Now let me give you a couple of figures. And I'm going to condense this for you. In May, anything that drops under 50 points is really bad news. But in May it was 56.1, and in June it was 53. It went down 3.1%. There's been a contraction of the PMI for about 26 for a few months. So this is not a good thing. It's telling us that the purchasing managers are not really that optimistic about what may be coming. Okay. The next thing is called the yield curve inversion. Now, I'm going to make this really simple. If you lend someone money for 30 years, and you lend someone money for 2 years, you would expect the person that's getting the money from you for 30 years to get a higher rate, because they're taking a risk of 30 years. Anything can happen in 30 years. Therefore, someone who's you're lending money to for 2 years or 3 months is going to get a lower rate, because the risk is less. A yield curve inversion, think about your old high school math. A yield curve inversion is when the person that's borrowing money for 2 years gets more of an interest rate than the person for 30 years. What does that tell you? That tells you people don't have confidence in the economy for 30 years. They want to get the 2 years, get their money, and get out. That's what the basis of a yield curve inversion. That has happened twice since the last report I gave you 3 weeks ago. So that's a negative sign. Let's look at the housing market. I'm going to breeze through this really quickly. What we look at the housing market is the housing markets per unit. And in April, and in May, and in June, there's been a steady decrease in the housing market. It's gone down about 14%. That is not a very good sign. Now let's look at employment. Employment is the sixth thing. Employment has been pretty consistent at 3.6 for the last 6 months. It hasn't really changed that much. So that's really not that much of a factor. Now I want to go back, and I want to talk just for those of you that are seeing me from a different venue other than the United States. And I just want to make sure you understand you have a central bank also, and what they may be called, so when you see the name. In the United States, it's called the Fed, Federal Reserve. In Japan, it's called the Bank of Japan. In England, or the UK, it's called the Bank of England. The ECB is the European Central Bank, and the Chinese bank is the PBC, the People's Bank of China. They are all central banks. They all have pretty much the same type of virtues or the same type of actions in terms of, again, money stability, regulations, controlling inflation, managing balance sheets, and providing guidance. Now, again, you need to tune in order to get this on the 3-week basis, because this is going to be something that's going to change. I'm going to go through a couple of things that have happened. We talked about the yield curve conversion, which is not a good sign. The job market is the unemployment rate is extremely low. There are roughly 2 jobs for every 1 person looking for it, which ironically in this situation is not a good sign. The president is asking for a gas tax release, and the president has released from the strategic backlog of gas. A lot of gas has been released. A note that I just got a couple of days ago is that the Atlanta Fed tracker, which is part of the Federal Reserve, is stating that it's looking like we're going into recession. And by the next video you will see from me, we will know if we are in recession. It will be about that time. There's also a crypto winter, which means that cryptocurrencies are under pressure. And the consumer price index, or inflation, is really very high right now. I'd like to thank you very much. If you're on YouTube, you need to subscribe. If you're watching me on Facebook, please follow me, and have a great day. Bye.